You are live.
Okay, welcome everybody. Today is May 8th, and today we have a new trade alert. First, we'll start off by reviewing the webinar teaser. And so, very good news for our strategy. The prediction was essentially that the Fed would be forced to wind down quantitative easing. At the same time, we're about to unleash $1 trillion a month in deficits. And this also comes at the same time they're now announcing we may push tax collection from July to December. So if we're talking about blowing up deficits, check mark on that front. The unemployment is at Great Depression levels and the stock market is rallying. We were very tempted to put on the final touches in our put options today, but I'm going to go ahead and wait for the Fed to announce how much QE it does intend to put out next week. So the H1 release yesterday, right at the close, dropped significantly, a 54% drop in the Fed's balance sheet growth, which is the only reason the stock market has been traveling up over the last 6 weeks. And that did crash again, 54% week over week. In fact, if we zoom in, we can actually see that this has gone from 605 billion at the height on April 2nd, the week of April 2nd. They added $605 billion to the balance sheet. That's 6/10 of $1 trillion in a single week. And this has been dropping and dropping like a rock all the way down to a 90% reduction in QE week over week this week. And I expect they will drop it even more next week. Meanwhile, the Fed futures are predicting negative interest rates by December. So this all points to the story that the stock market will tank and the bond market will steal all the fun. So we stand by that. And I was highly tempted to put on a very expensive QQQ put this morning, but decided to go ahead and get confirmation that they are going to drop down the QE again next week. Keep in mind, while $66 billion is a lot less than the 600, it's still $3 trillion annualized. So I'd still like to see that drop dramatically. And so that's the big news. This is what we've been predicting would occur and why we don't want to be buying stocks right before quite likely we're going to have negative 30% GDP quarter two, and consumer consumption's falling off a cliff. Earnings are going to get hammered. So yeah, there's just a lot of bad news coming down the pipeline here, and good reason to be playing the markets as we are. So I know a lot of people are not so happy about having some drawdown. I do want to point out, if I had not been listening to everybody whine about chasing stocks in January and February and had been really sticking to my analysis, we could have had this exact positioning on and be sitting extremely wealthy right now. So we did well in quarter one relative to Buffett or Ray Dalio, who lost between 25 and 30% of their total portfolio. So we're still outperforming the bulk of the market. But again, we could be sitting much prettier. So sometimes you do have to hold a little drawdown to catch the big moves. And so we'll go through the analysis here. But once again, I'm not going to chase stocks up when we're headed towards quite likely depressionary eras and extreme deflation, which is the exact opposite for buying stocks. So I'm afraid a lot of people sold stocks at the bottom, uh, ignoring our advice to sell at the top, one, and now they're going to be tempted to buy back into the stocks as we get near new highs and the economy is reopening. But I would argue that that's a terrible idea, and you'll soon end up in even more pain than investors did in March. And so it's no wonder rather Buffett sold his airliners because he doesn't think they'll be back to normal for years. Also, thanks to Ryan, he pointed out that we could simply retweet all the content I'm finding to Twitter, and then you guys can just subscribe to that and see the content as it comes through. So we will be just posting the content to Twitter moving forward. Highly recommend you follow our channel, which is at Generates Income. So that's the big news. The quantitative easing, the punch bowl of free money is coming to an end, or at least dramatically being reduced. We still have a good level of quantitative easing happening in other countries, but those are essentially buying up their bonds and supporting their economy and not directly affecting the US nearly as much. Plus, the quantity that they are putting in is a fraction of what we've even seen this week from the Fed. So all in all, I think we're getting very, very close to the top. And what comes next is the unleashing of $1 trillion a month of debt that's going to be almost entirely deficit because we're not even collecting taxes at this point in time. So that's the big picture. Next week, there's 330, or rather $313 billion of debt being issued, and this is going to be spread out between T-bills, notes, and bonds. So again, this is what we've been predicting all along and exactly what we want for our strategy to be playing out. Now, if this had come out with a print similar to the previous week, I'd be much more concerned. But yesterday in our boot camp live, we went through this in great detail, and it has dropped dramatically. So we'll just take a quick look at that. This is the website, thefederalreserve.gov/releases/H41. And again, this is where they give you a glimpse at what they're doing. Now, it's not going to be super detailed, but you get the basic summary. And again, you can't audit the Fed, which is quite silly when they control the money supply. But here we go. So they picked up 52 billion in treasuries this week. They sold 10 billion in mortgage-backed securities, which is interesting. 9.3 billion in labeled as other for repurchase agreements. They've put in right here in the Paycheck Protection Program, 11 billion. And we extended another $10 billion to central banks, which they label as liquidity swaps. So that's just giving these other countries access to dollars so they're not scrambling to sell treasuries, equities, or convert their own currency, which would push the dollar up. And again, it's really bad for emerging markets. So all in all, a growth of $66 billion in the balance sheet. Now, the previous week, if we go to the same report, we can see that they added $81 billion to the treasuries. They bought 30 billion in mortgage-backed securities, and they gave another 11 billion to the PPE program, or rather the PPC, the Paycheck Protection Program, and $27 billion in liquidity to central banks. So just giving dollars straight out to other central banks so they don't have to struggle to find dollars. Now that week we added 146 billion. Okay, come to the previous week, 255 billion dollars added, and we can see the breakdown was 146 billion dollars added to the treasuries, 110 billion added to mortgage-backed securities, and 13 billion given out to other central banks again. So that week was a $255 billion balance sheet. So if you're wondering why are stocks going up when we have the worst economic data in history, and anybody with common sense knows the earnings of corporations are going to be lower this year, not better. Well, this is your answer, and it's coming to an end. The reason why it's coming to an end is because the government has to raise trillions of dollars, and the mechanism to make that profitable for the banks are going to loan those trillions of dollars requires that they cut this QE business out. Otherwise, people are going to keep selling their treasuries for free profit and continue to load up on stocks. So QE is great for stocks. No QE and rate cuts are great for bonds. An expansion of debt is great for bonds, whereas a steady level of debt from the government is healthy for stocks. So it's no surprise every time the economy's in deep doo-doo, the government takes advantage of it and creates massive levels of debt. We go back another week, and they had purchased $206 billion in treasuries, 16 billion in mortgage-backed securities, and they had not yet been aggressively giving central banks outside of the U.S. access to dollars. So only 7 billion that week, 228 billion added this week. Again, we go back one more week and we can see 336 billion in treasuries purchased. Again, this is all allowing big banks to cash out treasuries they bought years ago for huge profits and rebalance into stocks. So this is the only reason stocks have gone up. There's absolutely no other explanation. So this week, 393 billion. We gave other central banks $57 billion worth of dollars that week. And on the mortgage-backed securities, $31 billion purchase. So this is all coming to an end. Here was the biggest single print in history in a single week of the existence of the Federal Reserve. And again, this was right after we bought our put options, guys. Literally about 10 days after they came in with over $500 billion of free money for banks. And so they picked up 361 billion in treasuries, 55 billion in mortgage-backed securities. They gave primary dealer credit facility 19 billion, the money market mutual fund liquidity facility 39 billion, and an outstanding $158 billion to other central banks, again, trying to get them to stop liquidating assets, get their hands on highly desired dollars. If we go back before that, it was a $506 billion print, very similar. So you can see they ramped it up to stabilize the market and to essentially, with all these treasury purchases, about half of it went to the US Treasury, so into the coffer of the government, so they could do all these small business loans, paycheck protection, stimulus checks. Basically, $1 trillion was quickly added to the Treasury's coffer to start dishing out. But those Treasury issuances were all on the front end of the curve. And again, they were just printed by the government and not actually sold to foreign entities. So this is just essentially taking money from your checking account and moving it to your savings account. It's really not creating any new money for the government. And that's why we now have to switch gears from just doing accounting tricks and actually sell this debt. And we've been seeing in the last week, foreigners are jumping on our debt issuance. And so I think next week we'll see a lot of people wanting to buy our debt. And this could be very well the top in the stock market in the next 2 weeks. So let's talk about when I think we could hit a top and the strategy with our put option for the TLT.
Hey, we'll get that audio back up as soon as possible, guys.
Okay, we're back. Sorry, guys. I accidentally had muted myself that time. Okay, so we have basically two actions today. First action is to sell to close the 5/8/161 TLT put. The second action is to buy to open the 5/29/161 TLT put. So if you notice, we've bought a little more time premium, and this is really the longest extent I think we need to wait for the market to start to sell off and for the TLT to bounce. We'll talk about that when we look at the Treasury issuance, but At this point in time, this is the best trade I have until we get one more confirmation. And again, I want to see that the Fed is indeed going to reduce QE again week over week. So the VIX puts, had we purchased our set a little later, we would have done much better. The Amazon earnings were weak, and that did cause these VIX to not generate a profit. So that is a 100% loss. We're allowing that to expire worthless while holding on to the remainder of our VIX puts. The next step, again, if you're a pro member, is to sell to close the 5/8/2020 161 TLT put, 4-cent credit, initially a 22-cent debit, and then to buy to open 161 5/29 2020 TLT put. So essentially what I'm telling you here is that I think there is a short-term risk that the TLT could pull back with all the issuance coming in next week, and that I'm going to extend the duration to 5/29. By 5/29, I do expect the market to begin a major shift, and that's for stocks to be falling and for bonds to be rallying. So this gives us all the protection we need to stay put and not need to make any adjustments on the TLT until that point in time. Now we do have some call options, which we'll be looking at selling and then readjusting those strikes much higher. So that is the only change to the portfolio today. If you're a basic member, again, you have no action. Allow your VIX put to expire worthless. And if you're a pro member, you just need to roll over your TLT put. Now I can tell you, I was inches away from putting the final touches on our portfolio. So I'll tell you what those final touches will be so that you can plan for that in the near term future. So again, near the close, we will get the announcement for how much quantitative easing is intended for next week. This week it was 8 billion a day. Craig, can you spell out, can you post the open positions you have in the chat box and then let me know what your question is? Because I'm not quite clear. And are you following the basic strategy, the pro strategy? Are you using margin? What's going on there? Okay, so while he gets that in there, I'm going to go ahead and continue. Here's what we have for our portfolio today and what I expect to do as soon as Monday. But again, I do want to see how much QE we're going to do next week because we have quite an exciting period coming up where we're going to be dumping $333 billion a week, not a month, a week, into the Treasury issuance. And at the same time, the Fed's going to stop buying treasuries. So this means the market has to absorb this. And again, let me pull up the TLT trade. Yeah, you should be able to see that one, Marlene, quoting at $1.47 currently. Okay, so let's go through the trade document, what we have to build today if you're a new member, and what you can expect to add in the near future. So again, we were at 8 billion a day of purchases in treasuries this week, which is about $40 billion. So if you do the math, if we're only going to have the Fed buying $40 billion of bonds per week, and maybe less, imagine they cut that to 20 billion, and then you're going to have your treasury go dump $313 billion. Well, that is a ton of money that's going to have to be coming from somewhere. So I do believe this is going to be what's going to change the market's direction and as soon as next week. So to be clear, I have bought the 5/29 put on the TLT because I do assume there's a short-term risk of a yield spike immediately when this auctioning begins. But that in itself is what will cause the market to tip over. Okay, so that is why we have the longer duration today. leading right into this event. And again, Marlene, this is indeed for the pro membership. So Marlene's been doing a kind of a combo package. I would only be buying the TLT put if I had lots of 100 shares of the TLT, Marlene. So if you're doing call options, totally different. I would just buy the underlying, especially going into this high risk moment in time where we're cutting QE out, we're ramping up debt issuance. Bill's asking, what's the effect of buying corporate debt? So that will help companies have some capital to either do stock buybacks, which is silly, or to hopefully, keep people employed, would be what obviously we'd prefer to see. Yeah, Marlene, I would focus on the basic membership if you're trading with a smaller account. It sounds like you've been kind of mixing positions from both. So yeah, the put option is designed to protect half our portfolio, which is in the TLT. Okay, so let's talk about what we have coming down the pipeline. So the next trade is going to be a very expensive QQQ put. And I was tempted to place that today. I'm gonna go ahead and wait till quite likely Monday to place this. And the strike I'm looking at is 210. So it's near the money, it's expensive. It's going to have a lot of time premium and will be the final touch to our put options on the US equity market, at least until we are well below that strike. So expect that trade to come soon. The VIX options, we have 2 weeks to exit, and I do anticipate these going up in value from here if the Fed does a healthy amount of QE, or if this trend just stays flat for a few more weeks. So I still think these can derive a profit, and this is still a recommended trade for new members. So if you're just joining today, these are all positions you can build right now. The next big position you can put on is a set of out of the money put options. And again, if you're trading with 30,000, we instruct you to cut these positions in half. If you're trading in multiples of 75,000, then you would take the full allotment. So pro members take the basic trades plus the pro trades. And the basic memberships following the US equity market, the pro membership expands your assets into bonds and commodities, as well as emerging markets. So this is what basic members can put on today. Most of your capital will still be in cash. You're just taking advantage of very leveraged options. Now, if you're following the pro strategy, here's what you can build today. So first off, our single largest and most important position is the TLT ETF. This is what I believe will be the highest returning asset for the next 2 years minimum with the least volatility. So it's absolutely critical and the single most important position in our portfolio. If you believe there is deflation coming and negative interest rates, which is what the bond market is signaling, which is what our data is showing from everything, then this is really the key position to build. So we have nearly half our capital just in the TLT ETF playing that 30-year treasury. So again, we're protecting that with the put option. And I do need to remove this. This is the put that expired, and this is your new put option up here. So the married put protecting your TLT is the 529 2020 161 TLT put. We're paying $1.42 to protect the TLT for the next 3 weeks. So again, this goal here is for the TLT to go up in the period of 3 weeks greater than $1.42. And I'm actually thinking the TLT is going to break above 180 in the coming months. Kathy's saying, how much should we have in cash? Well, it depends on when exactly you built your portfolio and which trades you followed, because the prices have been changing. Mike's asking if the bond market's signaling negative rates, why would yields spike? Yeah, I'll cover that. Absolutely good question. Okay, so Craig says I have a margin account and I'm following both the basic and the pro. I have a whole bunch. Okay, Craig, I want you to email me a list of what positions you have open, how many shares and how many contracts, and I'll be able to get back to you via email. Okay? And then also let me know how much real cash is in there and how much margin you're using. I'll try to help you out. So yeah, right now, Kathy, we have, if you're a pro member, you have about 80 to 90% of your portfolio put to work at this moment in time. Okay, so what's coming down the pipeline? We need to lock in the gains in GDX. So we've been buying puts protecting GDX all the way up. GDX has given us a lot of profit versus the cost of our puts. And so my intentions are once again to lock in those profits by buying a in the money put option, as this is an asset I think will rocket higher after we get to a sell off in the stock market. So again, this provides two values for us being long gold. If the central banks do not stop doing QE, then or do it for a longer period of time than we're anticipating, then we really want to own products related to inflation, such as the gold miner ETF. On the other hand, if they want to really fund these deficits, and they do need to do that to really fix the economy, then they really need to allow the bond market to appreciate. And for that to happen, stocks and gold are likely to crash. So I think we're getting very near a top. I would say no later than 529, we begin the descent, and potentially as soon as next week. And this is based on, again, a huge problem for the markets. You have $313 billion worth of treasuries to sell, and your Fed may only be picking up a tenth of that. So they may be picking up as little as 20 to $40 billion next week. So 40 billion is what they provided this week. If they do reduce this by another 50%, they'll be buying less than 10% of the debt being issued. So that's the mechanism that can create a short-term spike in yields, which turns around and drives money into treasuries and pulls it out of stock. So we'll take a look at that in a moment. And I'll show you how this happened in the Christmas massacre in 2018. So expect to buy an in the money put option to lock in the gains we've had in GDX. I do not think it will go up beyond the month of May. And that's why, again, we want to buy a long expiration in the money put to lock in the gains on GDX. Okay, next position is USO. We're expecting this to spike to around 60, and our goal is to sell the underlying for a profit. So again, that's USO, the ETN, and then remain long the put option. So in the pro membership, we have purchased 300 shares of USO, and we're protecting it with 3 USO put options. And so once again, the maximum loss is realized when you buy this put. If you did nothing other than hold the put option until expiration, if USO is trading below 20, you're going to walk away with $20 a share, and your only loss will be the cost of your put option. So whenever we buy an in the money put, realize you're locking in your maximum loss at that very moment in time. Okay, so we'll talk about the analysis of USO. The timeline for them to take action there is really running short. So now they're hyping up a trade deal again, which is comical. So I think we have a few weeks or less before the government can really save this market before the big move down. So again, if we do get the next big leg down, I would do the opposite. I'd be willing to sell my put option for a profit and remain long these shares if they do not resolve USO in the immediate future. So that's really the two outcomes there. This is our favorite position, FXI. This is betting that we're going to be placing tariffs on China and potentially restricting capital to ETFs that funnel money to China. And so this can either go up if the general market goes lower, or if it's delisted, it's the highest return we can get. So the cost on this is about $1 for the put. And if it were to be delisted, then you would walk away with $31 a share and only lose the cost of your put. So with 1% of your capital invested in this position, you can potentially walk away with a 30% return just from that single trade. So to summarize everything, we essentially have two upside hedges, which are these two trades here. So you have a QQQ call. This trade is doing very well, and we will want to sell it in the near future, probably next week. We have a volatility play. So the market just needs to travel flat or slightly up for VXX to crash. So this is, again, another way to make money if the crash doesn't happen for a few more weeks. Highly recommend both of these trades at this point in time. This is your very leveraged out of the money put options. This will only generate return when the SPY is viciously falling lower. Expect to add a much more expensive QQQ put as soon as next Monday, although I'm going to wait for the QE to really run dry, which we'll know more news towards the close of today. If they drop it from 40 billion to 20 billion next week, I think that's plenty to place that trade right away on Monday, especially when we realize there's 313 billion a week that's going to be sold, and the Fed's only willing to pick up a very small amount of that. The VIX puts today just allowed to expire, worthless Greg. I was hoping Amazon would drive the market higher right after we purchased those, and they came in with a disappointment, so we did lose on that position. And I think the VIX plays are coming to an end, so that's why we're not buying any new plays, just using the two that we still have open to serve that purpose. Now, moving into further into the trade alert, these have two different strategies. TLT really does well if we have bad GDP. And I think without question, we're going to have negative GDP in Q2. The big question is, how fast can we get people back to work and recover the economy in Q3 and Q4? And so my expectation is a very slow recovery and that we're going to have bad GDP prints for quite some time. And think about the people cashing in on something like 26 weeks of unemployment with an additional 13-week extension. How are you going to get your company back to work when you're sitting pretty on unemployment? That's a good question, right? So the bond market really does well if we have bad GDP numbers, if growth is stunted, if there's deflation. And without question, that is my strongest single conviction of what's coming down the pipeline. So this is our best position, largest position. And again, my highest confidence for the next 2 years is to park your money in the TLT. Now, GDX and USO are the exact opposite. So GDX is a position that you'd want to be buying if you thought the Fed was going to continue doing QE. Now, I've just shown you plenty of proof that they are not continuing QE and that they're rolling it down substantially. So this position, I believe we want to lock in gains with an in-the-money put in the very, very near future. So we'll take a look again at how much QE is coming in next week. But that's really the single reason to buy GDX is if you're in a time period where there's substantial quantity
Audio's coming back in a second, guys.
Okay, we back? There we go. I'm sorry, guys. Yeah, I have a new headset coming in, guys. This was a super expensive headset, and they added a new feature that if it doesn't hear incoming audio, it turns it off. Okay, so let me repeat. My apologies. So GDX, we want to be buying if there is QE. So you got to look. Was there QE in the last month? Yes, tons of it. Is GDX up a lot? Yes. Now, do we think QE is going to continue? My answer is no, because we won't be able to fund the deficit. So I'm going to look for confirmation that the QE is being cut. I'm guessing it's going to be cut in half. So this week they promised $8 billion a day. I'm going to expect between $4 and $6 billion a day next week. And this is at the same time they're going to finally start unleashing the debt into the open market. So now real participants are going to have to pick up that debt. And so yeah, expect to be locking in gains in GDX in the very near future, as early as Monday, just like the rest of our put options we want to add. Again, if we see the Fed's going to keep another $8 billion going in per day, I'm going to potentially delay that call another week or two. I bet that they're going to drop it from 8 billion a day to 6 or 4 coming into the next week, which again is signaling that you have to buy and hold debt to generate a profit and that you can't be flipping it. So this is really the trend we've been predicting, and here it is coming to fruition. USO is a inflationary product that you really want to own if you think we're going to be consuming lots of oil here in America and driving up the price of oil. That's not what I expect. Again, this is a trade where we're taking advantage of essentially May's front month futures contract on WTI went temporarily negative and created a huge discrepancy in the prices of WTI from month to month in the futures curve. So we're expecting that this will be fixed and that there's a short-term opportunity to jump into USO for a profit, selling it around $60 a share. So that's what I expect to come from some government interventions in the near future. So this is already sold off to where I believe the US equity market is potentially going to sell off. So it potentially could stay flat despite our expectation of the stock market selling off. So it's, again, a very good leading indicator of what's happening in the real economy. So we'll take a look at USO and the charts and the strategy on that once again. But expect really two outcomes. If USO were to crash significantly lower, I would be willing to sell my put and remain long USO. On the other hand, if USO spikes, I would like to exit USO for a profit and remain long that put. So those are really the two outcomes you should expect. Okay, we're continuing on. And we do have a new headset here by Monday, guys. I apologize. This fancy headset has some battery saving features that a lot of people on Reddit are pissed about, not just our group. So that'll be fixed by Monday. Okay, so here is the positions you can put on right now. Again, this was the position we just closed, and the current TLT put option we're recommending is the 529.161 TLT put. This protects us until the end of this month, and by then I do anticipate these moves to be underway. GDX, you can currently pick up the 821 $28 GDX put, but next week, potentially, again, if this is correct with my prediction that the QE is going to be cut in half once again, we're going to want to lock in these gains because the fun for gold will likely be over. But this is my favorite asset once we get to the bottom of the crash. So we want to be long this right now and use our put options to protect the gains thus far. And we'll talk about that timeline again. USO, there's no changes, and this is all you would do I don't anticipate adding any new puts to this position, and instead just, again, staying course. FXI, I will be adding an additional put as soon as next Monday. Now they're trying to hype up that we're back to trade talks, which is comical. So I may delay that a little longer, but in general, this is the opportunity to make a 30-to-1 return if the US puts serious sanctions on China. So first, I think we'll see tariffs. Then we may start doing sanctions against specific companies in China. And the real big hammer would be to essentially start restricting total capital flows to all ETFs related to China, and potentially even delisting some of these Chinese ETFs. And they could also be removing special statuses regarding Hong Kong. So that report from Mike Pompeo is due May 25th. And right now, they're about $75 billion behind on their trade promises. Of course, they're going to blame it on the pandemic, but that's a whole nother story because they knew about the pandemic well before they signed that trade deal and forced a clause. So all in all, if you're a basic member just joining, you have anywhere from 5 to 15% of your portfolio currently invested, and you're sitting on the sidelines. I want us to be picking up XLV, IBB, IHI, ONLN, and ITA at about 50% lower than it's currently trading. So we're sitting back with a lot of cash to buy those ETFs. And why those ETFs? Well, much of the economy is not going to be the same anytime soon. Okay, so we'll look at that analysis. But my expectation is that the government's going to have to sell trillions in debt, and it's going to hand that money over to a handful of sectors, namely healthcare, biotech, and medical device sectors. So I can see their profits just rocketing higher just from the subsidies that the government's going to provide. On the same hand, e-commerce is really set to thrive while retailers and malls are really set to be punished as we have to remain in the social distancing realm for probably another 12 to 24 months. So it's pretty easy to anticipate that e-commerce, once it is repriced to a more fair value, can outperform other sectors of the S&P 500. And then finally, I think that ITA will be our value play, with Boeing just really getting everything possible to go wrong for it. So I do anticipate we can pick this one up probably at a 60 to 70% discount from where it trades at today. So we're being patient to pick up these, and then we'll buy them and sit back for some very, very easy returns. Just look at the returns you could have made in 2009. Or in 2002, if you were smart enough to predict a stock crash before it happened. Okay, and remember, all these markets before they crash are bubbling up before tanking lower. They always have a dead cat bounce after the first leg. So I'd argue that you're in the first dead cat bounce in a potentially multi-year stock market crash. And we'll talk about timing, but that's how you make the big money with the least risk. You short the market with a little bit of your capital, then you sit back and you buy the stocks up for pennies on the dollar, just like the big banks will be doing. So we'll outline that and show you exactly the timing and what factors are affecting my timeline for that. Now, if you're in the pro membership, you have much more capital put to work. We're going to have to essentially sell all of the puts in our portfolio, get rid of the USO position, to be able to free up about 40% of our capital to buy those same stocks that our basic memberships are in. And Mike's saying the dead cat bounces lasted 68 weeks in the 2000 and 2008. Yep, good point. And again, really, we don't want to just assume because it was 68 weeks in those instances, it'll be the same this time. Really, what I'm curious about is who's going to buy the $313 billion in debt being sold next week if it's not the Fed? So that's really the force that I see pushing markets lower. So again, if you're in the pro membership, you have most of your capital put to work, and we're going to have to time getting out of our puts. I'm thinking it's going to be right around the election when we're going to want to sell those puts and be near a 50% decline in the S&P 500 from this current level. If you're in the basic membership, you're putting a small amount of capital to work and then sitting back to buy, again, these assets at very, very low prices. So just look at 2008, go look at 2000. Okay, so they were quite easy to predict that you're at a top. There's a lot of warning signs, from inverted yield curves to concentration of capital into only a handful of companies. We've got depressionary level unemployment. We know that 70% of our economy is consumer, and almost a third of the workforce is now out of work. Okay, and now we're going to go dump $313 billion of debt that the Fed's not going to buy every single week. So I think we're very, very close to the next big leg down, highly confident, and there's no way on God's green earth I'd have you guys buying stocks right now. So that's the positioning. We have some buy and hold positions that we have not changed yet. So I'm keeping all our positions that are not a good buy at this moment in time. For new members, right here at the bottom, so you can easily find our open positions that are a hold. So the most time pressing are these two, the 23 put on GDX, quite likely will expire worthless. And then we have our 157 call. I'll likely sell that as late as the expiration date. So that's in the money. So not a huge urgency to sell that. The other two, I quite likely will sell near the same time we sell our 157. And then we're going to adjust our strikes much higher with these TLT calls. I'm now looking at it bursting through that 180 level. And so we can expect to see some call options that are in the 175, 180, 185 strikes, and we'll readjust our expiration dates to be timed with the election. So that's really my big prediction, is that the markets are going to tank into the election. And again, this is expiring worthless today, so that's not a trade today. In the pro portfolio, we have 6% drawdown with the boot camp trades. Without the boot camp trades, we're down 7.5. I want to point out the majority of our losses are sitting in these put options that have a lot of time premium. So it's not like we have a closed loss. We have an open loss on a very leveraged option contract with up to 2 years of time premium. So those can still generate massive returns as this series of events unfolds. So yeah, it's unfortunate that the day after we made that first put option purchase, the Fed decided to go from not saving the market to pumping $2.5 trillion into the market. It's unfortunate that I didn't react to that $2.5 trillion aggressively so that we could hedge these losses. But now the funny money is coming to an end, and we really have just one big dynamic, and that's $313 billion a week of debt to sell, and the Fed's not going to be buying it. So you got to ask yourself, who's going to buy it? And the answer is the big central banks, the big primary dealers are going to be buying that debt. And they do not like to lose money, especially when they control the printing press. So the whole strategy to ensure they make money with loaning trillions of dollars to the government in the coming weeks and months is, again, to just stop the QE, and if they need to cut rates lower. And right now the market's signaling that we may be going to negative rates. Now, I would expect the Fed to wait for the next leg down to apply those negative interest rates. So you heard it here first. I do think by the end of the year, the Fed will be putting the federal fund rate to negative territory. Okay, now in the basic membership, we have a little more drawdown because we didn't make money with GDX and we didn't make money with the TLT. And in the buy and hold, you also have very similar drawdown. Now, keep in mind the buy and hold strategy targets the same strategy as the pro portfolio with inverse ETFs. So you do not need to have options to follow this program. And it's based on $1,000 lot. So if you have less than 30,000, you want to follow this exact strategy. All you have to do is buy 1 share of TEX, 1 share of FAS, 2 shares of Yang, 3 shares of the TLT, 5 shares of GDX. And again, we have one VIX put currently still good, which is the 515 $28 VXX put option. And the rest of your portfolio is in cash, and you have the same strategy. Once we get towards a bottom in the market, we will rotate out of these inverse ETFs and buy up that same group of ETFs that will benefit from all the debt the government's selling. So TEX is your inverse tech companies, FAS are inverse banks, and Yang is going to be your inverse China equity ETF. So you have very similar allocation as the strategy up above, but without having to use options. And it works for account sizes as low as only $1,000. Okay, so that is a good review of the strategy. I still believe we can beat our returns from last year quite easily. And I think we're going to see the drawdown come to an end by May 29th and for this big move to begin. So everything that we've predicted has come true in terms of the really the core analysis here, which is the government's going to blow out its deficit and that the Fed's going to have to wind down its QE to achieve selling the debt. So that's the big prediction. And so far, that has been the case in the last several weeks. Where did I slip? Well, should have waited a little longer to buy those puts. I was waiting for a breathtaking rally to buy them, and it just seemed like that was not going to be coming our way. So we bought those puts, and the second after they came in with $2.5 trillion of quantitative easing. The good news is that has come to an end. So I would absolutely positively not endorse buying stocks at this level, thinking that this trend is going to continue, because again, the primary driver of your market rally was 100% the Fed, and the Fed's not doing that action anymore. So again, 66 billion a week annualized is still $3 trillion. I do want to see that drop again this week before we really put on the final touches to the portfolio and then sit tight. Okay, we went for 1 hour. I'm gonna go ahead and take a quick break for Dean to review our options for new members, and then we will continue with the news, articles, and analysis.
All right, thank you, Jason, and thank you all trial members. Hope you all got some really good education here. And just real quick, there's a couple options on your screen to work with us to help keep your portfolio safe and build wealth safely, okay? And the first option, folks, is the boot camp, okay? So if you're kind of maybe a beginner trader or a mid-level trader and you're really looking to take your experience, your knowledge, okay, and your ability to make money in the stock market to the next level, the boot camp is a phenomenal way to be able to, you know, lift and drive that ecosystem, your confidence, and your intelligence when it comes to the market, okay? The boot camp is really neat, very interactive, you know, seminars that we have. Tuesday, we sent out a really cool content email that's a culmination of all of the best interviews that Jason has watched over the past week. Typically, it's going to be, you know, some of the smartest minds in the investment world. Some, you know, from time to time, you'll hear from different hedge fund managers, different, you know, investment banks. It really just kind of depends on you know, what it is for the week, but it's really a culmination of all of the best content that we've reviewed over the past week. That's sent out to you on Tuesday, so you can really amp up your level of education and knowledge about the markets, how they work and why. Okay, really the core thing it's going to do is teach you how the financial system works, number one. Okay, number two, it's going to teach you about some really good bonus trades that are built in there waiting for you. And one of them we're targeting 100-to-1 return on. And, you know, after that, you're going to start learning about options. You're going to learn how to fill out your spreadsheet, A to Z in there. Okay. And then throughout really the next probably 2 to 3 years, you're going to learn how to literally understand options inside and out, forwards, backwards, sideways, upside down, right? And learn not only about those options, but how and why to use them in different market scenarios, okay? So just really cool program. And it's going to take you from any level of trading to a professional level of trading, okay? And then the modules are actually produced on Thursdays. So really between your content, email on Tuesdays, that'll probably takes typically about 10 hours to get through the content, and it's really awesome content. And it's neat because you can, it's in a YouTube playlist, and you can literally just play it as you go walking or as you exercise or go ride your bike, whatever it is you like to do in your leisurely time. You can, press that play button, have the interview going in your ears. You really don't need the visuals. So it's really cool and something that I do in my free time. All right, and in the bootcamp too, folks, you will get a full year's access to our pro portfolio at no cost. So it's a nice little added incentive and bonus there to go with the bootcamp. And eventually, once things settle down with coronavirus, we will have a live trading session that we will invite you to out in Albuquerque, New Mexico, where we are headquartered. We have been debating really taking that into consideration when we're gonna actually be able to host something like that. But that's kind of in flux here, so that's kind of a neat little part of that, and certainly look forward to meeting you in person, shaking your hand, maybe have a beer or drink with you. Okay. Next option down is the portfolio, the pro portfolio. This is going to show you how to trade like the best hedge fund managers on the planet. Okay, you're going to have the highest level of trading activity in the pro portfolio, and you're going to have the highest level of protection as well. All right, and this is what I'm using with a substantial amount of capital, and just really enjoy how bulletproof it is and how much it doesn't swing around as much as the market does. And it was really cool in February and January, and the market was down up to 34%, and we were up well over 6% during that period. So that was really, really neat to experience. And I think when things get really crazy in the market, the portfolio just absolutely shines, and it's all about consistency. That's a really neat portfolio structure. It took us a long time to figure out. But for you, we simplify it. We engineer the trade alerts. You take, literally a minute or two to replicate the trades with your broker. The pro portfolio will give you up to about 10 hours a week access to us to ask questions live, okay, to get your education here, to learn more about the markets, how they work and why the central bank controls the marketplace, and the three largest asset classes that matter, okay? Next is going to be the basic option portfolio. This is great, guys, if you have between 30 and 75K. All right. And basically, right now, it is just using options to take advantage of market moves. Okay. When the time is right, we will tell you when to get back into the market with this strategy as well. But for now, with all the risk that is presented to the marketplace, it's much smarter to, just take options here and there, right, and have capital ready on the sideline for when we see really good opportunities come by. Okay. And last but not least is the buy and hold portfolio. Wonderful if you have less than $30,000 to invest, or you're not comfortable with options, one of the two. You can use that portfolio, and really simple. You just use a mix of asset classes, okay, and you use ETFs to simply be long or short asset classes. Really, really simple portfolio when it comes down to it. Just 5 changes were made last year. Just 5 changes have been made this year. So really simple. And the lowest level of engagement with us, you will have, webinars with us on Monday. Okay. So, but still 3 hours of live interaction with us every single Monday. Changes will be made on Mondays. And that's about it, guys. So really, the more interaction, the more trading you want with us, that's going to be the higher value items, right? But if you want to really kind of just sit back, relax, place a couple trades throughout the year, buy and hold's good. Basic portfolio, guys, it trades 3 times a week. Okay, Monday, Wednesday, Friday. Perfect if you have between 30 and 75K. Pro portfolio, absolutely loved by investors, high net worth investors. You have to have a minimum of 75K to build a structure. Okay, but we literally have people with up to in excess of $4 million behind the system, but at the same time, we have people using it with 100K. Okay, and also the boot camp, kind of our highest level of interaction. Not only will you get all of the boot camp information, but you get a year of the pro portfolio for free, and literally you'll have access to all of the education that we create in the boot camp for the rest of your life. So pretty cool. And if you all have any questions, just call me or text me. Okay, my number is 505-322-7515, and you can literally just call me or text me with that number. And if any of you all have any questions on the programs, would love to help you in any way that I can. So feel free to type in a question to the chat box or simply unmute your microphone. More than happy to answer any question I possibly can for you.
Okay, very good. Let me go ahead and continue the presentation here. All right, guys, so I do want to get into some very important data here. William's asking, yeah, if you guys have questions about the trading plan or the trade alert today, please post it. I do want to go through the analysis while we have everybody, and then we can go into open mic after that. So yeah, William, I do want to buy some more puts, but as I said, I'm going to wait till next week, most likely as soon as Monday. But again, we do want to see the QE really dry up. Okay, so let's get into the meat of the presentation. Okay, so the first thing we should look at here is it's right here. So this is the most important news that we were looking for. And again, it was the expansion of the deficit at a growing, accelerating pace. And so for the last 6 weeks, the strategy the Treasury did was to just sell T-bills and to keep this issuance quite light. And at the same time, what they were doing is just buying this up from the Fed, and essentially that's going to keep yields flat, and it's not going to cause people to buy and hold. So that's what we saw for the last 6 weeks, and they've done it very aggressively. Now what we have coming down the pipeline is the Fed's not going to be buying debt, and they're moving it to longer durations. So the government would love to sell this debt at the lowest interest rate possible. And so that's really the big picture. You have $313 billion of debt to sell every single week, and now the Fed's not going to be buying it. So this is all going to be put into the hands of the central banks that buy it, which is going to be lots of big central banks, and then your primary dealers, which is mainly JP Morgan, Goldman Sachs, all the big US banks. They have to buy these treasury auctions, and then they can redistribute it. Gary Barber is saying, is there some way I can access the links you're going to start putting on Twitter without using Twitter? I don't do Facebook. I don't do Twitter. Yeah, I just download Twitter, Gary. It's a heck of an app. And that's where you'll be able to find the links each day. But yeah, definitely just download Twitter and follow my one account. It's a free phone app and it'll allow you to do that. Okay, so this is the big picture. We're growing the debt, but we're not going to be growing the balance sheet. If those two things happen at the same time, causes yields to drop, money to flow into bonds, and the stock market to sell off. So that's really the big picture. Now, to understand why we're having to create so much debt, that's important as well. So we'll get to that question next. But the key here is we have too much debt to sell. The Fed's not buying it. So you got a $300 billion shortage week over week for the foreseeable future. So is there a short-term risk the yields spike? Yes, but if they do, I expect those to be highly temporary and for the big force to essentially push markets lower here. Okay, let's see what other questions we have coming in. Okay, so that's the first slide that we want to be looking at. Let's look at the yield curve. Okay, so the next slide, we're looking at the yield curve right here. And I want to point out that the yield curve inverted in January, and it also inverted mid last year. So we can actually go back and show you that. So the yield curve tends to invert ahead of a recession. In fact, it's done it before every recession. It usually gives you anywhere from 6 to 18 months of a heads up. And so the Fed has a pretty straightforward strategy for dealing with such an event, which is to cut interest rates. And so they did. And what was the result? The front end of the yield curve fell to these very low rates. They've been forcing these to remain low by buying these up at the Fed. And this has dragged the 30-year Treasury lower. So my anticipation is, again, that these are going to head to negative territory without the Fed purchasing them. And we actually have seen that today. And we've seen the foreigners fighting over these T-bills last week. So we're finally seeing, again, the Fed stop buying the debt, and we're actually selling this to people who are going to have to buy and hold. So again, my anticipation is this yield will drop significantly, most likely for the next several years, as long as we have to sell a tremendous amount of debt that can't be funded by tax dollars. So that's the big prediction coming down the pipeline. And it's counterintuitive that you can increase the supply of debt and then cause the yield to drop. But it's because of this mechanism that the Fed's cutting rates lower and lower that forces these to travel lower as well. So this is, again, my highest conviction trade is to be long the TLT. And again, we have about half our total capital in this single trade. Now let's look at the top news next. Okay, so here you have your 2-year yield hitting a record low, slightly negative in the Fed futures implied rates. And the teaser we had was actually showing that you had to go way out till November, December to see negative rates. But now we're seeing May futures hit negative. So again, everything's telling us one picture, and that's the economy's in very bad trouble, which is not good for stocks, despite you seeing a rallying stock market. That again is only because of the Fed's massive purchases. And those purchases are again coming to an end. We're now getting some hype about a trade deal. So we know how trade deals go. I'll deep dive into that, but I would estimate that there won't be a trade deal. And I think this is like the 3rd time we've had a phase 1 trade deal as well. So it's quite comical now at this point. This is expected to have meat prices spiking this month. And again, this was the original working conditions that was causing so much spread. Mexico and Brazil are having extreme outbreaks. They can't control it. They don't have enough capital to be able to do this. Marlene says, I have a technical question. Why isn't the 515, 157 call showing a profit rather than a loss since it's currently priced at 164? Well, time premium and change of price versus where we purchased it are affecting that trade. We've seen the aides of both Trump and Pence test positive in the last 24 hours. So some alarm with that. Trump's projection of the death count continues to rise rapidly. Earlier last week, it was between 60 to 70. Now they've jumped it up to 100 to 110. We'll look at our modeling. With what we're doing right now, it's probably going to be much, much worse than that. Tony's asking about the trade. Let me pull that up for him. Yeah, so we bought a little bit extra time premium, the 529 161 TLT. And that is the longest I think we need to wait for the correction to begin, or for the dead cat bounce to run out of steam here. So that's why I chose that strike. It also gives us a little bit of time to allow the bond market to have an initial shock from all the debt being sold. And then I believe that is when we're going to see the big move. So again, I could see TLT pulling back a little bit, yield spiking as all this debt starts to flow through, and then the money starts to flow out of equities into treasuries. Now, same note, it may just not ever happen. So again, I do think that we're very close to the end of the wait for this trade. Is that any questions on that, Tony? Is that good? Okay, Pennsylvania. So even though the White House is trying to get everybody out to work, what we're also seeing at the same time is that they're actually having governors refuse to do this. So we're actually starting to see a divide here, which is very interesting. And again, further supports that the economy is not going to be opening right back up. We're not going to be getting all these jobs back. And so again, companies are going to make less and the government's going to have to borrow more. More negative news coming out about hydroxychloroquine, which only costs $1 a pill. And if you deep dive into that, they're giving it to people who are on their deathbed and then saying it doesn't work. They're not using the zinc. So I do think there's quite a bit of a cover up for this treatment. And Dean, could you take a few questions from Roth real quick? I do need to readjust this headset. I'm sorry.
Up and in Roth, if you scroll to the bottom of the screen, there's a little gray bar that will pop up. Okay, and then if you go to the bottom left-hand corner, you're gonna see a little microphone icon. If it has a red strike through it, you can actually click that, and then it will unmute your microphone, and then you can interact here live with us.
No one can unmute right now.
Oh, okay. All right. Well, sorry about the little delay there, guys. Jason's having some audio difficulties with his headset, so sorry about that.
Okay.
All right, and Roth, if you want to,
we should be good now. Okay, let me continue on the presentation. Sorry about this, and we will have a better headset for Monday. Okay, so they're looking at delaying taxes to December in this article. Again, further pushing the deficit higher, and at the same time, just further increasing the risk of a stock crash and a blown out deficit. This is an article from Wall Street Journal, which talks about how much of their staff just does not want to come back to work because they have a half a year of unemployment with a bonus, and some states are extending that an additional 13 weeks. So now employers are having to beg their staff. And at the same time, we're facing consumers starting to save and not spend. Okay, now the next article we have is the CDC provided a very detailed guidelines of how to reopen, probably similar to the scientists against the virus. And again, they told them that they should just throw this in the trash, that it would never see the light of day. So again, this does come into our timeline picture. Trump administration buries detailed CDC advice of reopening. The guide from the scientist PDF we shared about a week ago was even more detailed, but again, they're not putting any of these precautions to work. JP Morgan's Bob Michel, US won't stabilize for 10 years, which again is reconfirmed with Buffett, who again, his best friend is Bill Gates. So I'm sure Bill Gates told him this is quite likely to last years to dump those airliners because they're not going to be flying at full capacity for years to come. And also, I want to point out Buffett did not buy anything during the crash. He waited for the April bounce. Lucky he knew that timing, right? And he got out of his airliners completely, which he owned 10% of the top 4 airliners. So the writing is on the wall. Next article, Moderna phase 3. Everybody's rushing through the phases to get a vaccination out. Big race to make money, and they are forgetting about safety and protocol here. Also, we've seen Bill Gates hype up this company quite a few times. So I do think we need to keep a close eye on their results, and they are saying that they can start phase 3 by this summer. So again, there are about 5 rapidly progressing human trials. This article will outline that for you. Who the big companies are, where they're at in the trial timeline, and we will have to be pretty patient for the next 6 months to see the results. Second potential COVID-19 vaccine backed by Bill and Melinda Gates is entering human testing. So another article. I do believe you will find that Bill Gates will have invested in the successful vaccine that does become released, which again, we're going to want to be buying on the dip, not at these levels. This is a Business Insider article stating the same thing. So they have a very fancy, unproven technology coming through for their vaccine. And again, we've seen Bill Gates mention it over and over and over and over again. Now, as far as trying to get a grasp of what percentage of the population is at risk, I do look for anecdotal tales. So first we had the cruise ship, kind of case studies, a good petri dish to see who all would get sick. But now I'm starting to pick up these stories of entire families becoming infected. So this is indeed a family that had this in San Diego. The whole family got it. And so very interesting to see the infection rate and risk of infection. Previously, we had highlighted a story out of Jack. So yeah, I bought the longer TLT put because I think there's a risk of the trade going against us until the 29th. So that was the date of the TLT put option. That's the longest I think this trade, this market can rally. Although I do believe it could stop as soon as Monday or today for that matter. Good question, Jack. And keep them coming. If you got more questions, Jack, post them. Okay, money supply grew rapidly. So again, this is coming to an end. and not something you should count on for the foreseeable future. We've shown you the proof of that drawing down rapidly, and we'll get an announcement before the close of how much QE we can expect next week. I'm guessing it's going to be between $4 to $6 billion a day. This week it was $8 billion a day was the announcement. If you're not buying stocks after 20 million Americans lost their jobs in April, you're doing it wrong. Just a joke. US President Trump asked about US April jobs number, says all those lost jobs will come back very soon. I don't think so. It took 10 years to get these jobs, and we lost them in 6 weeks. And most of the companies that had to lay off people won't be back to business as normal anytime soon, not until there's a vaccine out, and by then many of these will be insolvent. The big unanswered question and most important question is how many of these jobs will come back and when? Here was the image from the webinar teaser graph showing Fed future funds rates going into negative territory, which again is signaling much lower yields ahead. Extremely good for our portfolio. Blame China, save the economy. Trump campaign embraces for new 2020 messaging. So almost without question, this will be the big headline. There's an important study that's put out once a year that's been delayed to May 25th about whether China is treating Hong Kong fairly, which could be a big bargaining chip with our trade war issue with China. So that's one thing we want to watch coming down the pipeline here as we get these headlines that US-China trade talks are back on track, which is such a joke. US Trump virus got out of China, probably through incompetence. We'll be making announcements soon on WHO. So I've got some good details on that to share in a moment. Late in 2019 and early 2020, the bond market never confirmed the Fed-driven rally. And guess what? The bond market was right. Now, again, the bond market is not confirming the rally. Bonds and stocks are sending opposite signals. I'd say this is the biggest disconnect I've seen between bonds and stocks in a long time. I think we need to be very mindful about what the bond market is telling us. Tony put out the ticker for the new company. And again, I would not be buying biotech companies right now. So again, I do anticipate the entire stock market, regardless of it being Amazon or any other biotech company, falling with the general group. So we will want to buy those, but not until they're selling at likely half their current price. I said on Chinese social media that China needs to expand the number of its nuclear warheads to over 1,000 to strengthen nuclear deterrent. Given the US rising strategic ambitions and impulses targeting China, it received over 60,000 likes. China pledges no first use and it loves peace. Ah, interesting. So now they're threatening nuclear war if we start to pick at them. A bunch of new bankruptcies today. This is just the very start of it. Think about it. We went and essentially handed out $1 trillion to random companies, regardless of whether their company would survive or not. And that was just to delay the layoffs, to delay the bankruptcies, to delay the failures. And so now they are all going to be running out of cash in the coming months. So there's quite likely lots of defaults in loans, lots of rents not being paid, lots of unemployment. So this is a huge issue. And it's been covered up with the $1 trillion of bailout that we just pumped in the past month. But again, I do anticipate this will be coming to an end in the very near term. Trump says he's having a hard time with China. No joke. Now this is interesting. The consumer revolving debt crashed $28 billion. So is this banks removing credit? I would anticipate that's more the case versus actually people paying off their credit cards. But again, this is the same trend that happened in the 2008 crash. Chinese Vice Premier Liu He had a phone call. Okay, so we're back to trade hope, which again, quite clearly, China doesn't want a trade deal because phase 2 would again clip their wings. 7,000 of the state's 16,000 wells have now shut. Production has already fallen by 500 million barrels a day. So again, this is what we want with USO, is production to stop and for the storage capacity to increase. So those are really the 1-2 punch for USO to deliver a big profit. And this is coming to fruition as well. The Federal Reserve is tapering their asset purchases a bit and increased their holdings by 65 billion last week, up to 6.72 trillion on the Fed's balance sheet. And it's still 3 trillion annualized. Now this lady is long gold and doesn't seem to think QE is coming to an end with this comment or her positioning. But as you guys know, I do think gold is going to sell off as the QE comes to an end, because if everybody gets rich buying gold, we're not going to fund the government. We're not going to get this all the holes in our ship plugged. So once again, I highly doubt QE will continue as we have to issue these massive deficits. This was a video that was quite good and removed from YouTube, or at least hidden. And so I watched it. It was good information. The article he discusses, I provide a link for. This is a second video from Peak Prosperity, which was very good, highly recommended. This is the article which he was discussing, and this is incredibly important. I'm gonna go ahead and post this link in the group chat. I would highly endorse everyone reading this. I'm gonna summarize it for you. This is published quite some time ago, 3/15/2020. But it's just really getting circulated now. It's written by an anonymous scientist. And so what he goes through is the argument that this was a man-made virus. Karen says, if you think the TLT may have a little pullback next week, why don't we take, because I really don't think it's going to pull back, Karen. I'm just providing the protection in case it does. I expect the opposite to begin as soon as Monday. And it really, really has to do with how much QE they're going to do. If they cut the QE down, again, I would think we're literally at the top today. So we'll look at that data on Monday. So this is really important. So this goes through the case that this was man-made. And I'll summarize it for you. You're going to have to read it to really get to the high level of understanding. But essentially, they can show you that 98% of this virus matches up perfectly. Yeah, so to be clear, Karen, I think there is a risk that the TLT could go against us until that date. But in general, I don't think that, and that's why we just have the protection with the put. I'd much rather see the TLT go up starting Monday, and I think that could very well happen. So yeah, that's why we didn't sell that call today. So yeah, I was very close to be very clear to putting 100% of our capital to work by adding a bunch of expensive put options today. So I'm delaying that trade. I think we're very, very near the tipping point where this portfolio really shines. So not to be confused. The worst case I see is waiting until May 29th for these big moves to begin. But I do think it could begin Monday. So here's what's really important about this article. You can go through the details, but essentially they can show you that this is 98% exactly the same as a bat virus, except for one tiny part on the spike protein. So half of the spike protein that allows this to get into humans is identical to the SARS virus of 2002, 2003, which was found on a camel. So that was a virus that could easily get into a human and infect them. Now, the bat virus on its own, without that addition, does not have the capacity to infect humans. So that was one thing that was completely unnatural, is that we can go look at every bat virus we've ever collected, and you won't ever find one that has this spike protein or anything like it. But funny enough, you can go find the exact same spike protein on the SARS, the original SARS virus. And then to make it worse, what you're seeing in the orange right here, you only find in the influenza virus, which is what we were talking about yesterday. So that makes it even more effective at infecting people. And again, you won't find that part of the genome in any bat virus or SARS virus. So if you go a little bit lower, they highlight that. And so the green area is the insert. Let me zoom in on this. So if you zoom in on this, let me zoom out a little bit. Okay, so what we have here is the genome, and it's a long piece of code. We can literally type these out and print our own viruses now. Yep, I did post that, Ignacio. So here's the bottom line. Let me see how much I can zoom in on here. What we have on the left table right in this area are the most similar viruses. So we have the Wuhan strain A, that's the one that came out of China. We have the second variation, which we're finding in America, where the spike protein just manipulated or mutated slightly, and that does look natural. Then we have the two bat viruses that are 98.5% correlated. And then we have the original SARS from 2002. And so the author is pointing out that this section right here, you can note that this part of the genome is extremely identical to SARS. And what's critical about that is this is what allows the bat virus to suddenly get into a human cell. And you can see the bat cove just doesn't have this sequence whatsoever. So it's just completely missing. Okay, then this part is the next addition to the spike protein, and that's this PRRA. So this is helping it grab the furin and makes it much more efficient at infecting people. Okay, so this you won't find on any of the similar strains. So that's why scientists have been saying this indeed looks like a human-made virus, that these mutations are not natural. So normal mutation, you'll see a couple little letters change throughout the whole entire sequence. You don't see an entire section magically change, and especially magically change in a way that is extremely beneficial for the virus. So you can just see the high correlation of that genome. And again, the orange section right here is what matches up to SARS. And then the green section, you really wouldn't find anything like this unless you go look at influenza viruses. So that's really the smoking gun that's very hard to explain. So how did China explain that when all these reports are coming out? And again, people talking about this article are getting their videos deleted off of YouTube right now, or at least hidden. So he goes on to say that the lady who did make these discoveries in the Wuhan lab comes out with a new genome that she put out after all this had been well exposed. Let's get to that part. Okay, so this is a section where he talks about what was their response to this research. Well, the Chinese head scientists came out with a new genome code that they said they found 7 years ago. That's 99% a match to this current genome. But the thing is, they never published that. And if they had found something this dangerous, you got to ask yourself, why would they publish every other piece of research they found, but not this supposed genome that's highly correlated? And also, with every other scientist collecting bat samples around the earth for the last 10 years, nothing is anything like this new one they've put out. And in fact, they don't still have the physical samples. We can prove that that genome is real. So he is saying that that looks fabricated and false. And so that's really the best evidence. So this is the best evidence we have that this was indeed made in a laboratory, and that it's highly, highly unlikely that this was a natural mutation. The first response the Chinese had was that this must have been from a bat that bit a pangolin, and then magically had something from the SARS virus show up in the pangolin, and then humans were messing with pangolins, and then that's how it made it. At the same time that these bats are naturally in hibernation. So yeah, this was put out quite some time ago. This is the best analysis that I've found that this was indeed human-made. So Dara says, we've known from day one this is man-made. I was assuming it was, but I hadn't seen proof of this scale and actually seen the genome laid out and highlighted this clearly, as well as the excellent explanation of exactly how this was put together. So essentially, they took the bat virus that's spreads rapidly, but normally wouldn't affect a human. They pulled out part of the spike protein from SARS, which is known to be able to get a leap from camels into humans. And then they took a piece of the influenza virus and put that in there as well and made it extremely efficient at infection. And so that's why we can go find these case studies where an entire family is getting infected. So yeah, the point of this is that if this is man-made, then that's a lot different than this being a complete accident, right? So we can anticipate that there's going to be retaliation on China for what's transpired from this. So that was the most interesting article I've read in the last 24 hours. So here is things China doesn't want you to know, a little timeline of what China's done to cover this up. China begins censoring news and keywords related to the virus on search engines and social media. December 31st, China orders virus samples destroyed, issues no publication order. January 3rd. January 5th, Wuhan stops releasing data on new cases until January 18th. January 12th, day after the Shanghai lab leaked the virus genetic sequence, China shut them down. January 13th, first cases in Thailand, Japan. Neither infected person had been to Wuhan seafood market. Also, there's a lot of people trying to hunt down patient 0 right now. And so there's a fisherman in France who's never been to China, who I believe they found later from the autopsy had this way back in November. So how on earth do you get it back in November? We also have a lot of athletes that went to the Wuhan War Games in October who are now trying to find out if they caught it back in October. So yeah, it's really important to figure out where exactly this started, how long it's been spreading, and anybody who says it came from the Wuhan seafood market should be shamed at this point. January 20th, China admits the virus spreads between humans despite having evidence of transmission in early December, right before they signed the trade deal and forced a clause saying they can get out of this if there's a pandemic. And sure enough, they've not met their phase 1 deal at all this year. They should be at 100 billion by now. We're at 25 billion. January 23rd, after 5 million residents have already fled Wuhan, the remaining residents are given an 8-hour notice that the city will be locked down. Hundreds of thousands more flee the city. January 24th, China prevents the Wuhan Institute of Virology from sending samples to other countries that are working on vaccines. 15 cities in China are now under lockdown. January 23rd to March 27th, International flights to and from Hubei province proceed without restriction from China. China orders local airlines to keep flying. May 27, China bans entry to all foreigners. Chinese citizens can still fly to China from anywhere in the world. Before March 27th, 90% of the infected people entering China were Chinese nationals. Okay, so it's quite clear they've covered this up. They've allowed it to spread. They were indeed manipulating the virus. Does the story go much deeper? Did US officials have their hands involved in this? Yes, we know that the Australians, the Americans, the Canadians, and the Chinese were all collaborating doing this research. So the story will get much deeper as we go down the bunny hole. But at least we now have a pretty indisputable piece of evidence that's clearly easy to understand that this indeed was a bioweapon. And so the main people who are trying to put out evidence that this is not man-made are the exact scientists who are funded to do gain of function research. So that's really the big, I think, lesson that we're going to come out of this, is that we should make it illegal to be studying how to manipulate viruses and make them deadly and extremely virulent. And that's exactly what we have at our doorstep now. So yeah, what does that mean? How is that important? Well, it's critical for us to predict, again, how long we're going to be in lockdowns, killing our economy, and when consumer behavior can go back to a more natural state. Ignacio says, ban biological weapon engineering worldwide for all time. Yeah, I think that's the big lesson here. Absolutely. So for timeline, we want to figure out how long is the bond market going to go up and how long is the stock market going to crash? That's really the big question here for our intents and purposes. So if we believe that the government is going to have to, Jack wants to know, TLT, what's your question, Jack? Yeah, so Jack, the big picture is the next 2 years, TLT goes up. We have a short-term shock to be worried about. The short-term shock is that you have $313 billion of debt being sold every week, and you only have the Fed picking up less than 40 billion of that a week. So the market's going to have to come up with the cash for this, and that's what's going to tank the stock market, just in very simple terms. Now, is there a short-term risk that the second that bond issuance hits the market, that yields could spike? Yes. So rather than have everybody freak out in our group, we have a put option that covers you till the 29th. So you don't need to manage your TLT position until the 29th because we have our put. And so I don't care how low the TLT goes next week or the week after that, we're not changing anything. We're going to remain long the TLT and let that put option do its work. So there, I do believe there is a short-term chance that you see yield spike the second all this debt hits the market. But as it spikes, that's going to be what's going to drive money out of the stock market and into the bond market. So that's the prediction there, and why we have a couple more weeks of upside hedges. Yeah, let's just look. So let's just see what I'm essentially telling you with the trade alerts without having to get too deep into it. So the QQ call generates profit if we go higher. I'm going to sell this at 230 or sooner if I think we've hit a top. So I'm getting ready to sell this. I would expect to see this sold before the 29th. Okay, and as soon as next week. Your VIX puts, again, if the market's just going to trade sideways, this generates profit. We have a 515 and a 522 expiration. Unless the Fed is coming in with another $8 billion a day in quantitative easing, and I see other central banks are ramping up QE, I'm not going to be buying any more of these puts. This gets us close to that 29th date, which I think is the absolute longest this dead cat bounce can last. So don't anticipate new VIX puts. These generate profit if we go up or flat. SPY puts, we have the positioning built, and we're going to add to this soon as we believe the Fed is done with its expansion of its balance sheet. So at the close today, I will get the announcement of how much they are going to be. Yeah, so I just answered that, Jack. Yeah, the QQQ call we're going to sell in the next 2 to 3 weeks, as soon as next week. The bond position, we're going to be buying and holding for years to come. And the timeline of how long we need to hold the TLT is directly related to how long it takes to get the economy back and running. So if we can predict when we get the labor force back to work, we can predict when the government's going to stop bailing out the economy and stop issuing such massive deficits. And it's these deficits that are going to cause the stock crash. But the reason we have these deficits is because the economy has collapsed and now the government has to bail it out. So understanding the coronavirus and its impact on the economy is critical. That's why we are spending so much time worrying about how this virus works, what it's made from, who put it into the world, and what their intentions are, as well as when can we solve the crisis, either with a vaccine or with herd immunity. So my basic thesis to you is, as long as the government has to bail out the economy, you want to be long bonds and short stocks. And that the mechanism for them to raise trillions of dollars is going to be one in which they have to stop doing QE at the same time they blow out our deficit. And that's because your yields won't go lower if you're giving everybody a free out clause to sell their treasuries. So they have to cut the QE before they ramp up the deficit. And it's no coincidence that the QE is coming to an end, and next week the big fireworks begin for issuing the debt. So is that clear? GDX is again a hedge in case they don't stop the QE. Now, we've done well with that position, but I don't think it's going to keep going up. So expect me to buy an in the money put with a lot of time premium on GDX in the very near future. USO is already crashed relatively 90%. So I just don't think it'll go much lower. And I don't think it's going to be that correlated to the stock market in the near future. So I do think we're going to get a short spike on this, and that'll be our opportunity to get out. I believe this spike will be caused by a reduction of the supply, which means oil drillers are going to produce less oil, and the government's going to come up with storage capacity and potentially make a one-time purchase to help ease the problem in the oil sector. So if that doesn't happen, the stock market crashes just from oil being so low. So USO provides a totally different opportunity to make money. That's really breaking from the reality of the stock market. So the stock market should be much lower right now, just like oil, but it's not, and that's because the Fed came in with $2.5 trillion of funny money. So that's our basic strategy here. We have the put option protecting GDX with a lot of time premium, but we blew way past that. So we need to buy a new put at the 35 strike so we can lock in all these gains. And again, once they start pumping the QE again, that's when we really want to predict that's going to happen and sell our puts well before that. So again, I would expect us to sell just about every put option in the portfolio around the election period. Okay, so there's a clear group of very powerful people that do not like Trump. They want him out because he's ruining their business model that relies on a positive relationship with China. So that's really the big fight that's happening and what's coming down the pipeline in terms of my predictions that Trump's only way to have a chance at winning this election is going to be blaming China for all the pain the United States is having and then pinning that on Joe Biden, his relationship with China. So I think that will be a big part of the coming election, and also why we wanted to own the FXI put options. So that's really a good summary of what our positions are and how we're set up to profit from from what's coming down the pipeline. Let's see, Ryan, let's let Tom speak. Go ahead, Tom. Sorry, I didn't see your hand was raised. And then we can do Ignacio next. Meanwhile, I'm going to pull up my model. There you go, Ignacio.
So I'm interested in FXI. I get the impression this is American money in the American market wearing a Mao suit. Like these are the Americans in the American market investing in China, right?
Yeah, so it's called a ADR, American Depositary Receipt. So yeah, it's like a little certificate that gives us a right to a foreign currency. But the laws for what they have to report are highly different than what US companies have to report. So that's really where the legislature's pointing out and putting pressure on these American-based ETFs. That's right.
So, but the FXI has it behaving in such a way that it seems robust as if someone is propping it up. That means the overnight it raises its value without any trading in the after hours market. Who is doing that? Is that the central bank, the Fed?
Shanghai. So yeah, so the return of FXI is going to be directly correlated to the underlying value in either the Hong Kong exchange or the Shanghai exchange. And so yeah, China has been propping up their stock market absolutely as they continue to spew out all this, fake data to the world.
So it's the operations of the central bank in China holding up the Shanghai exchange, and that gets reflected almost like a peg in the FXI.
Exactly. Yep. It's a lot like somewhat like the TLT in terms of its not actually being directly connected to the asset. So yeah, it's called a ADR.
ADR.
And so China can print out a 2-page summary with whatever accounting they feel like, and that's all that's required with an ADR. So that's the big critique that we're seeing the legislation start to be at least brought up, that this should be outlawed. So the prediction here is that we're going to restrict capital flow to China. There's a big index right now that has $10 billion that would go to China that they're trying to prevent. That's one. And then two, start forcing audits on the Chinese companies by American auditors, which is illegal for communist law. So there's a huge problem there. 2, 3, tariffs will absolutely hurt these companies. And then 4, we start picking on Hong Kong and also starting to isolate individual companies. So just in general, that's the overall play with FXI, is expecting geopolitical tensions to rise and to potentially even outlaw the ETF altogether, or greatly reduce the capital that's allowed to flow to it.
Sustaining the American markets, the indexes and such, being done by the big banks and by the central bank, has nothing to do with the value of FXI, which is being supported in China? I mean, these are two different levitation acts.
So wait, can you say that question again? I'm sorry.
So it appears to me that the resilience of the dead cat bounce that we're experiencing in the markets is result of the big banks, and maybe even the Federal Reserve, holding it up, levitating the American exchanges and the stock as well. Now, FXI is traded in the American markets, but as a result of Chinese manipulations in Shanghai. So that if it is a trade war and it gets warmer than cooler, that the Chinese would try to defend the Shanghai market and the Americans would try to defend the Wall Street. So these are competing interests that are going to be reflected in, say, the SPY and the FXI?
Sure, let's pull up the chart.
mean, was that clear? Or am I hallucinating?
Oh, I would agree with those two statements, but I would also tell you that you can't fund a multi-trillion-dollar deficit and protect your stock market at the same time. You can do one or the other at the same time.
Both China and U.S. in that regard is true. True.
Yeah, I would agree that they both want to protect all their assets as much as they can, but that they're going to be unable to do that and blow out their deficit at the same time.
Dang.
So let me pull up the chart that's most related to this. So we'll just overlay the SPY and FXI. So from this point of view, we can just argue from this diagram that it's very unlikely for FXI to go up in value and for the S&P 500 to diverge against that trend. Now you can find instances where FXI is weak, but the SPY is strong. But you, with almost no exception, will not find a period of time where FXI performs well, but the SPY doesn't. So if we do believe the S&P 500 is going to fall from these pressures, then without any intervention or geopolitical tensions rising, it would be very foolish to think that FXI could go up and the US stock market would go down. So that's one. But two, I do anticipate the US government applying maximum pressure on China in the next 12 months. So I think how daring will they be ahead of the election is a good question. But I would think that we're going to expect in the next 30 days, well, in my video, my predictions in the next 90 days, but I do think it could be sooner than that. And keep in mind, the review of Hong Kong was delayed to the 25th. And I think that was so we can have a little period for them to figure out what we're going to, are we abandoning the phase one trade deal? Are we going to keep that playing for a little longer while we try to get the economy opened up and we're facing record unemployment? So timing of when they're going to start bashing China, I think is somewhat difficult here. But yeah, the big picture is we've pulled the free money out of the market and we're about to dump massive debt into the market. So that's really the most important flow of money to follow next week. But yeah, FXI is a American ETF that is much like many different index products. And so the general idea of what I see coming down the pipeline is first, more tariffs because they failed to make their trade deal agreement. One, two, payback for the spread of the virus and covering it up, which I'm not quite sure exactly how they will frame that. Three, there's currently a massive index that was planning to add China that was going to get them, it was either $10 billion or $50 billion from that one index that government's currently trying to prevent. And then you start putting more capital restrictions for money to flow to China or Hong Kong. And then you start requiring their companies to provide audits, otherwise they're delisted. So that's really the some of the big things we can do. And then on top of that, we can start sanctioning specific companies. So last time around it was ZTE and Huawei, but there's a whole host of companies they can start targeting. Then you start going after all of China's business partners for rolling out the 5G network. So just in general, I see a pretty nasty fight between US and China developing in the coming weeks and months. So that's why we'd want to have these FXI puts. Not only is it highly correlated to US stocks and goes down when US stocks go down without any exception, it's also quite likely going to be the focus of the geopolitical tensions going into the election period. Also, it's very important to stir up trouble when you want to sell lots of debt, and the US government knows that better than anyone. So those are really the big reasons to be short FXI with that put option. But yeah, I would agree that China and America are trying everything they can to protect their stock market, but they're doing it in phases. So they didn't try to go sell a bunch of debt while they're trying to pump the stock market. So they've pumped the stock market up nearly to where we were in 2019, which is absolutely insanity when you look at negative 30% GDP coming into quarter two. But now they're focusing on selling the debt. And as we've seen, they're pulling back the QE. So I think the next big focus will be how much money can the government raise through the bond market so it can come in and push it through its economy and try to fill the holes in the ship.
Am I still
Yes, sir.
on? Oh, I do not know what are the internal American political factions that are facing each other for the. I'm so sorry. There are people in the U.S. for China and against China, and I don't know who they represent in the American society, and I don't know what those people or how those people are connected to the banks, to the five big banks in America or something. Is that a clear question?
Yeah. Trying to decipher who's pro-America and who's pro really multi
The globalist, the
the
nationalist,
globalists. Yeah.
who's got their hands in the government, who's got their hands in the banks.
I don't think it's going to be as easy as saying the Democrats are pro-China and the Republicans are the hawks. So I think it's very difficult, and obviously those people who do have bribery from China need to keep that as secretive as possible. So yeah, no, it's quite clear. You have a group of elites who have a lot in common with the elites in China, and they don't want this relationship to break down. They love the cheap labor. They don't care if China is going to take over certain sectors as long as it's not their sector. So indeed, that is the and that's why you can see the just absolute insanity in the mainstream media, which I watch very little of. As you can see, that there are clearly two big powers fighting over this and politicizing it. But yeah, we just pulled a 700% return on our EEM put last Friday, and now we're getting this much more targeted for FXI rather than emerging markets. Although I think the entire emerging markets are going to be in very big trouble because China's growth is going to really slow down, and they all rely on China growing and not contracting. So this contraction in China as manufacturers are getting pulled out is huge. In fact, they almost crashed the world stock market right here in 2015. But then they came in and blew their GDP to debt ratios from 150 to currently over 300%. So they're running out of capacity to print money without price inflation. So the big complaint you'll find if you listen to these Americans who went to China 10, 20, 30 years ago, they watched this remarkable growth in China. They had cheap food, cheap cost of living, good income relative to their cost basis. And that's all gone out the window. Now what they have is poor quality food, extremely expensive food. Rent has gone up, so they're fighting inflation in China. So yeah, China's economy, and if you didn't get a chance to yesterday's boot camp recording, I think you'll really like Ignacio. In fact, I think I even mentioned in it because I noticed you weren't on it live. But I take you through the history of China's they really collapsed in 2009, and they have never gotten back up. All they've done is just blow out their debt to an unsustainable level. Oh, did you catch the recording?
I did a while ago. Thank you for your attention.
Oh, okay, very good. And yeah, I did really dig deep onto the terminology for the wording on that bonus trade. So very good. Let's let Tom have a question. Tom, you got your hand up, and Roth. Okay, it looks like Tom may have his audio muted.
Yeah, I can't get either. Unmute you.
Okay, well, let me get through some more slides here, guys. So the big debt's hitting, the QE's coming to an end. We're about to enter a trade war or some sort of escalation with China. We've got two really big, powerful parties fighting over control over the US government going into the election. So that's a recipe for disaster. At the same time, you've got depressionary level unemployment. And really the only question left is timing. So without question, I am 100% convinced TLT goes up, SPY goes down. And as early as Monday, I'm going to say that I do think we are very, very, very near the transition period. So the next big question is, how long does this last? And so that's why we always come back to our modeling to try to predict, when is this going to come to an end? So I'll just take us back through the same thesis that we need to ask ourselves to be confident in this set of trades. So let me pull up that. Okay, so the next question is, we have to ask ourselves, is this dangerous? Is this really warranted to be in lockdowns? And for a period of time, I was starting to question that myself, because they're counting everything as a death due to the coronavirus, regardless of it actually causing it. That was a big hype for quite some time. And I think without question, this is the best data we can look at, is to see that again, in a natural period of time, coming into the month of March, deaths are on a sharp decline. And that's been the case for the last century. In fact, there's good animation of this in Spain showing that. This time around, right when the death count should have been decreasing, it spiked to the highest prints we've ever seen in history. And this is in the US as well as in 24 European countries. Okay, so unless we think this data is fake, you do have to really admit that this does seem to be a very dangerous virus. Okay, so that is critical to our timeline. Next question we have to ask ourselves is, when can we get back to work and get our economy fixed? So they can go print all the money they want, they can do all the stimulus they want, they can sell all the debt they like, but at the end, productivity is derived from labor producing goods and services. It's not produced from the Fed adding a zero to its balance sheet. So until we can really believe that unemployment's going to come back and that business is going to operate and that we don't have to be worried about wearing a mask when we go into any store, and that we can really just get back to normal life, well, then we have to figure out when in the heck is that going to happen. And so that's when this modeling becomes very important. And so the modeling that we get from the government has been continually telling us we're very close to the peak, and that Trump was even saying that this may not ever come back, that if it does come back this winter, don't worry guys, we will put it out quickly, as if it had gone away in the first place. So that's why it's, while it may not be useful to test for antibodies to treat sick people, it does help us get a good idea of how much of the population has currently been infected. And so if we were thinking 20 or 30 or 40% of the population's already had this, then I'd tell you we need to buy the dip a month ago because everybody's going to get back to work in the coming months, and the economy is going to be fine by the year end. And only thing that will have changed is the money supply has been nearly doubled. So we can be expecting the best stock returns we've ever seen. But unfortunately, that's just not the story that we can paint with the data we have. So that's why I'm constantly looking for the results of two things: vaccine tests and antibody tests. So I really don't care who has a active case. I do care how many people have passed away, what the statistics are to get to a mortality, and how many people have had the disease in the past. So the active case count's completely irrelevant because we know that's highly manipulated by going in and out of lockdown. So a lot of people are like, wow, the active case count is coming down. Well, yeah, we just shut off the economy for 6 weeks and printed $2.5 trillion. So you have this extreme false sense of security by seeing stocks go up, you feel safe, which was due to $2.5 trillion of essentially just fake money, not real money. And then we had to put everybody in a lockdown for 6 weeks, and there's not really any clear guidelines or path to reopening the economy. And what is going to happen is going to be a tiny, tiny percentage of the amount of commerce we saw in 2019 relative to the next 3 to 6 months. So that's why we have to look at this modeling to get an idea of timeline. How long do we want to be long the bond market and short the stock market? So here's what my modeling tells us. Let's just update this. So it's been slowing down rapidly. In fact, they're going to tell us there is no new deaths. What a joke. Okay, 269. Okay, so on a worldwide basis, to achieve herd immunity, we need half the population to get sick. If we have 1 out of 10 people getting somewhat sick, and 20% of those end up needing hospital care, and then 80% of those who get extremely sick end up passing away, this doesn't end without a vaccine until there's 60 million deaths. That's a horrifying number to think of. And quite clearly, the governments would not be able to allow that to happen, not in a short period. So that does tell me lockdowns will come back as hospital systems become overwhelmed, which will happen if you don't go out with masks, have social distancing, which also, again, hinders your economy. Okay, so from this data, I would argue that at the very best case, worldwide, 5% of the population has had the disease, and as little as 0.5%. So we do know the death count today is a lagging indicator because you have a month of people who've already been infected coming down the pipeline who will pass away who were previously infected. So my guess is, again, 2% of the population has had it, 2 out of 100. That's not a lot. We're all extremely at risk of still catching it. To think you've already had it is foolish, and that's the case for most humans. Okay, what about in the US? Let's update our data. 76. Okay, in the US, we come right in at 2.4%. I would guess we're at 5% max in the US. So I have antibodies tests all over the country that's slowly coming in. The good news is they're ramping up these tests right now. Bad news is the data really is not very accurate. A lot of false negatives. So I think we got to be patient with this data and realize it's going to be a bit blurry for the next 30 to 60 days. The highest print I've seen to date is right at the epicenter in New York City, 20% print. You can go to other counties in New York and find prints under 1%. So even in New York City, we have populations with less than 1% antibodies. We can go to little towns in Colorado and it's below 0.5%. We can go to highly infected areas in California and Florida, and we can get around a 5% print. So all in all, I would have to argue that we are very, very early in the spread of the pandemic. I'm quite confident that's exactly what Bill Gates told Buffett, and that's exactly why he let go of one of his favorite toys, the airliners. Okay, so remember, he hates selling stocks. This guy absolutely hates to sell stocks. He'd much rather buy some put options and hang on to it, but you can't protect an airline stock for 4 years with a put. So you can understand why he let those go on the April bounce and didn't buy anything in the March crash. So timeline tells me that we have a long ways to go. So the next thing we got to do is pay close attention to what are we doing to slow the spread? Are we doing massive testing? Are we going to do a test 2 to 3 times a week for every child going back to school? We're going to do a test weekly for every employee who works in a public area. We're going to force everyone to wear masks. Or are we going to not do that? Let people do what they want. Allow people to get into gatherings. Open back up the gym. So right now, the path we're taking is essentially one in which I believe will increase the spread at a rapid rate. So give it probably 60 to 90 days, and I'd anticipate we're back into a very troublesome area in the US. So that's timeline. So what's the really the miracle long bomb that saves America's economy? A vaccine. So we got to study the vaccines being developed, watch the results coming out, and that can also give us hope for a sooner end to this pandemic. Now, trust me, I don't like wearing masks. I don't like this whatsoever. I've questioned many times, is this a hoax? I've dug deep in every channel you can possibly find, and the evidence continues to come in with one outcome, and that's that this is extremely deadly. It is man-made, and it's nowhere near an end. In terms of vaccinations and vaccines, it seems to be a long shot, and they seem to be skipping the normal protocol for how you safely create these vaccines. So I have an open mind to it, and they're pitching potentially a vaccine by January. That's why I think we may get a bounce into the November, December, January timeframe with a bunch of hype about a vaccine potentially being ready. So we got to see how this phase 3 comes out for a lot of these bigger trials happening, which we should have results for coming into the close of the year. And if those are failing, then we need to extend our timeline dramatically and keep a close eye on the development of antibodies in the population. So that's just really the simplicity to how we can predict these markets. And so we're focusing on where's the big money going to flow, and without question, it is going to the government. Okay, and it's going to go to the government at the tune of $1 trillion a month. I just really don't think you're going to see JP Morgan lose money on $1 trillion a month investment. And that's just putting them into a category of a bunch of big banks that are highly connected to all the central banks. So that's the big prediction here, guys. And we are coming right up on the cusp of all these moves in the market. So let's go ahead and take some last questions. I'm going to go ahead and close us out today with this content. Let me put the trade alert back up so we can look at it one more time. And please, if you do have any, we got the note. Fed went from down to 7 billion a day, so still a little bit of QE. So we got 35 billion QE next week from 40 last week. So with that note, I would expect us to potentially add the last set of puts potentially next Friday, considering what's coming down the pipeline. Let's see how the market reacts to this huge issuance. And again, the Fed is reducing that. I was expecting them to potentially come in at 6 billion a day. So they did reduce it, but not quite as much as I'd like to see to be ready to call the top at this specific point in time. Any last questions for today? Jack, go ahead.
Yeah. Once the balance sheet of QE is gone with Fed, I mean, could they come up with more?
Well, the Fed can do whatever they want. So they can either buy treasuries or manipulate interest rates. So we're predicting that they won't do that because they want to essentially make it profitable for big banks to loan the government $1 trillion. What they can't do is make it profitable to loan the government $1 trillion and prop up the stock market with QE at the same time, not at the levels they were doing. So yeah, I highly doubt that they will continue to do QE at the same time. We need to grow the debt.
Yeah, I
But-
want to ask you a question that always in my mind. When you say that U.S. can take out special interest of Hong Kong, what is that? What do you mean about that?
Yeah, so Hong Kong has a special status
What is
that
that? Yeah. Hello.
yeah, I'll pull it up for you so we can take a look at it. And so we did go over this in the boot camp yesterday too, Jack, if you recall.
Mm-hmm.
So I'll post these articles so you can read up on it. Okay, so the U.S. Congress is close to, this was published 2019. Okay, so the U.S. Congress is close to making a statement in support of Hong Kong democracy protesters to the dismay of Chinese leaders. Legislation passed by the House and Senate with only a single dissenting vote and now on the Trump's desk would amend the United States Hong Kong Policy Act of 1992, and under which the U.S. treats Hong Kong differently than the mainland in trade, commerce, and other areas. Rescinding Hong Kong's special status would effectively mean treating the Asian financial hub no differently than any other Chinese city, a seismic shift. So this is what's being reviewed by Pompeo, and he delayed it. It was due already, but he delayed it to the 25th. So I'll try to get all those quotes in for the next webinar for you. But a lot of those videos I've been publishing, where it's his most recent interviews, specifically talk about that review and how he's postponed it to May 25th. So that's essentially what that's in regards to. So yeah, I'll make sure to include the exact quotes from Pompeo about the timeline of that and what they were considering. And I think it's because they are going to either try to get some massive immediate purchases out of China for the trade deal or go to escalation. I think that's really what's on the table now is either China starts pumping a ton of money into the US to make good on that phase one trade deal, or we're going to apply extreme pressure, and that would be in the form of tariffs and potentially revoking Hong Kong's special status.
Thank you.
Yep, very good question.
Why is TLT pulling back again today?
So my expectation is the potential for a temporary pullback in the TLT as the supply is dramatically increased, and then a whipsaw where the stock market crashes and the TLT goes higher. So I would not be surprised if you see some volatility in the TLT, and that's why we bought the 529 put option. So it's counterintuitive that making yield spike would cause people to sell stocks and buy bonds, but that's exactly what could potentially happen. Now, everybody knows that relationship So there's also a chance that the TLT never drops and everybody just front runs that reaction knowing what will come before it occurs. So that's why I bought us a longer duration put, anticipating there is a short-term volatility risk in the TLT. But that I believe that will be less than 2 weeks in time. Does that make sense, Jack? The Twitter account is @GeneratesIncome. No, I think GLD will be highly correlated to the S&P 500. Yeah, so I'd expect the gold rally, the Bitcoin craze to come to an end by May, and for all the money to really be forced into the bond market. So yeah, I mean, just, think about it from this perspective. What's the problem? The problem is corporations are shut down, people are unemployed. So what's the solution? Well, we need to, it's either let all these companies go bankrupt and let business slowly come back, or use your government to try to enhance the recovery to be faster. And so that's what the government likes to do whenever they get a chance. Is if you have people losing jobs, you have defaults, you basically have your economy crumbling at your fingertips, which is what we have right now. It's hard to believe that with stocks near all-time highs, but you look at any other data point, this is a absolute disaster. It's a nightmare. So every single time in history when there's big losses in the economy, individual banks can't afford to loan money to resolve the problem, which they love to do. That's what banks are in the business of doing. Analyzing risk, loaning money, and then making interest or taking over part of your company if you fail to make your payments. So they love that opportunity, but this is so massive, the banks can't handle it. So they have to basically partner with the government to make these loans. So what's happening? $2.6 trillion stimulus plan is coming through, but where's that money coming from? The money is coming from the government. So the government has to come up with this, and they're not collecting taxes. So we have to go pull money out of other markets, bring it to the government, redistribute it to all these corporations, and give some money to, we're going to give $25 million to a small business, and they get to pocket 25% of it risk-free, as long as they pay their rent and keep some of their employees on the payroll who aren't working. And then you get $1,200. Lucky you. But in general, that's just the big pictures. The government needs to get trillions of dollars to fix the problem. The only way the government can get trillions of dollars is to pay a return to the investors who loan them the money. Okay, so that's really the big picture here. Government has to bail out the private sector. Their method of doing that is selling debt, and the people buying that debt are essentially the same asset as the TLT. So that's the big picture that's coming through. Now, did we stabilize the bond market for a month and a half? Absolutely, we sure did. And it was to the tune of $2.5 trillion. Are we doing that right now? No. Did we try to go issue long-term debt while we were doing QE? No. So it's no coincidence that they're now rolling the debt to longer duration. At the same time, they're ending or dramatically reducing the QE. So I believe you're going to see the top of the stock rally in May and the big transition that we've been predicting by May 29th and as soon as next week. The 161 strike was just a relatively cheap put that can protect us. So I like risking $1.40 for 3 weeks, anticipating that the TLT will pay off that put option substantially. So quite likely we're going to be having to raise trillions of dollars at the government level for the better part of 2 years. And so I'd expect the big QE to come in right around the same time we have a vaccine that works. So once we really have a solution to the problem, not just papering it up with funny money, and we can actually get the population back to work, that's when they're quite likely to come in with QE, because they want to allow the big banks who bought the government's debt get out for a profit without affecting the credit markets, and then to turn around and buy stocks. So we're just trying to copycat what JP Morgan and all the big banks are doing, which is buying up the massive amount of deficit the governments are issuing, holding that position until the real cause of this economic slowdown is resolved. It is not resolved right now. If I thought it was resolved, I'd be buying stocks right now. But it's not resolved, not even close, not by a long shot. So you don't want to own stocks. You want to own government debt. That's what we own. Once the real problem is fixed and we can actually get our population back to work safely, then we're going to want to predict when the next round of QE comes in and actually do the opposite of this trade, which will be to short the bond market and get heavily aggressive in stocks and gold. So that's my main message. I really hope people take it to heart. I know it's tempting to look at the stock rally for 6 weeks and think everything's fine. You can look at the message from our government saying this is all over now. It may not come back. You're safe to go back into public. It's just not the truth. It's not the case. We're nowhere near being a point in time where we can get back to work safely. We're nowhere near a point in time where commerce can get back to the level it was in 2019. And we're no longer going to be able to do this level of QE, as we need to actually sell debt. So that's the big picture. And I think that at the latest, this will top out by the end of May, but as soon as next week, when this really big discrepancy begins, which is where you have $35 billion of Federal Reserve support for treasuries, but you have $313 billion in pressure. So yeah, you can have a short-term reaction to that, but in general, that reaction is going to cause money to go to the bond market at the higher yield. If enough people are just fighting over that yield immediately, then we may not even have needed our put. So the put is protection for 3 weeks and allows us to not worry about any volatility for the next 3 weeks while we allow this to play out. All right, let's take any last questions here. Kathy got approved for Forex at TD. Took her 3 weeks. All good. I'm glad you got that up, Kathy. So yeah, that bonus trade is ready to rock and roll right now. A 1% position, or 1 mini, and I'll be willing to increase that if we get tariffs. And also, if we get tariffs, I'm also going to do the CNH trade, which is a really beautiful trade as well. So we can short the Chinese currency, we can short the Hong Kong currency, we can short the Chinese stock market, and we can also, I'm also looking into the ability to short the Chinese bond market, which is still at a very elevated yield compared to the US 30-year Treasury. So I know it's been a difficult few weeks here watching the market rally and the Fed manipulate this as you see bad data after bad data. I know you're tempted to jump back into stocks for instant gratification. That's why I gave us these upside hedges, and I've been very stubborn about not changing our core positions because maybe in January and February, it was questionable if this was all going to become a reality. It has become a reality. So now we have to face the facts and really play these markets smart and not be foolish and chase stocks that are clearly being manipulated. And that manipulation is, again, I can show you proof, is coming to an end. All right, guys. Well, I really appreciate everybody. We'll see you back Monday, same place, same time. Probably not going to jump on those puts Monday, likely wait till Friday. I would have liked to see that purchase. Oh, Tony has a question. Go ahead, Tony. And Tony had called the 290 on the SPY, so shout out to Tony for that call.
No, I don't know if that was me or not. That was another Tony.
Or did you have 270?
Yeah. What I was looking at is the fill on that EEM put. My fill was a lot less than what yours was, and I was wondering what time you filled, if you know offhand. I think mine was 452 or something like that.
Let's see what I got.
450.
Oops, that's the wrong track record. Mine was at 655, so I'll go back and double check that one, Tony. So you got 450?
Yeah, 450 on the nose, and that was right at 12 o'clock.
Okay. What did everybody else get on their emerging market put? Kathy got 655. Yeah, that's odd, Tony. I wonder why you got such a lower fill.
That's I put it in right when the alert came out. At least it's not a loser.
Yep. Well, I'll get more feedback from everybody. I tend to put my trades in about 20 minutes before we go live, so I try to get as close to the timing as possible here.
It does seem like we moved the market somewhat when we put in our orders. Sometimes.
Kathy sold hers at 1237 at 655. So. And you're using which broker, Tony?
That was through Tastyworks.
Tastyworks, okay. Well, I'll try to get more feedback from everyone, make sure we're getting the same fills here.
Right.
Yeah, and she did hers with E-Trade.
I have an account with Tasty Trade too, but I just happen to have this one in Tastyworks. I usually get pretty good fills with them, but I don't know why that went so haywire.
Yeah, that's odd. Well, we'll keep a close eye on that moving forward.
And if you could, I don't know if it makes any difference to anybody, but as a kind of an aid, if you would let us know what your fill is when you get,
Yeah, I did add that today. So I did add those today for all the fills. And also I input in the track record real time too. Karen got 650 Fidelity. Okay, good. But yeah, I'll make sure we have the entry prices. It is in the track record, obviously, as well. But I'll include it in the Word document too.
Right. A lot of times we won't see that until, later. But just an idea.
Sure. And I'm pulling my price about 20 minutes before the trade too. So before the webinar goes live. So we should be quite close. All right, guys. Well, thank you so much for your time. I will have the microphone fixed Monday. I apologize about the darn audio going in and out. Yeah, it should get exciting next week. We have the huge debt issuance and we got the Fed pulling back the free punch bowl. So I think our patience will be well awarded in the very near future. So I appreciate everybody. And we'll see you back. Oh, go ahead, Tony.
Yeah, just out of curiosity on the TLT fill today, I think I got from 146 to 147 on the fill. Does that sound?
I got it at 142, so you got 4 cents higher.
Okay.
And then 4 cent credit. Did you get 4 cent credit on your put? They sold.
I got a 2 cent credit against the 146. Net was 144.
Okay.
Yeah, so that's the same thing you got then, 144. on the roll.
Oh, okay. Yep. Very good.
Right, so it's been something weird about that trade. I don't know if I input it wrong or not, but just something to look out for
You
myself.
do a market order on that one or a limit or
I always use limit orders.
what's that?
I always use limit orders.
Huh, okay. Well, that's odd. I'll make sure to do what I did today on all trading, so you have it in the document,
Okay.
written format, and then plus you'll always have it in the spreadsheet too. And all the spreadsheets are linked to in every update down in this area and updated
Okay.
daily. So you can always dig through those too if you like. Okay, wonderful guys. We'll see you back on Monday. Appreciate everybody. And time for some fireworks next week. Thank you so much. And we'll see you back same time, same place.